They launched with 10 million subscribers in a single day. 10 million. 3 years later, billions of dollars had vanished from the balance sheet, and Wall Street stopped applauding. The streaming wars were supposed to produce a king. Instead, they may have produced a warning. And it wasn't a struggling startup that stumbled first. It was Disney. This isn't just about subscriber counts. It's about how one of the most powerful entertainment empires ever built walked confidently into a new battlefield and discovered that dominance in one era does not guarantee survival in the next. By the end of this, you'll understand the strategic gamble that reshaped Disney's entire business model, the structural weakness hidden beneath explosive growth, and why the real danger for Disney Plus may not be behind it, but ahead. This is a financial autopsy, and the patient is still alive. When Disney Plus launched in November 2019, it felt inevitable. Disney wasn't entering streaming as a challenger. It was entering as royalty. For nearly a century, Disney had mastered intellectual property at scale. It didn't just produce movies, it built universes. Marvel, Star Wars, Pixar, animated classics that spanned generations, franchises that printed money across theaters, merchandise, theme parks, and television. Streaming looked like the next logical extension. Netflix had proven the demand. Consumers wanted on-demand entertainment. Cord cutting was accelerating. Cable subscriptions were declining. The old distribution model was weakening. Disney's leadership believed they had something Netflix didn't: premium, globally recognized IP that families already trusted, and the early numbers validated that belief. 10 million subscribers in 24 hours, tens of millions within months. Then the pandemic hit. Lockdowns poured gasoline on demand. Households stuck at home subscribed in waves. Streaming became a utility. Investor enthusiasm surged. The story wrote itself. Netflix pioneered streaming. Disney would industrialize it, scale it, dominate it. For a moment, that looked true. But underneath the celebration, something subtle had changed. Disney wasn't just adding a new product. It was altering its DNA. To compete seriously in streaming, Disney couldn't treat Disney Plus as a side project. It had to reorganize around it. In 2020, under CEO Bob Chapek, Disney centralized distribution decisions. Creative divisions lost some autonomy. Content strategy shifted toward feeding the streaming pipeline. Subscriber growth became the North Star metric. That shift sounds logical, but metrics shape behavior. When subscriber growth becomes the primary goal, everything bends toward maximizing that number. Content budgets expanded aggressively. Billions were allocated to original series. Marvel shows multiplied. Star Wars spin-offs accelerated. Production pipelines intensified. The assumption was powerful and dangerously simple. If you produce enough high-quality franchise-driven content, subscriptions will grow and compound indefinitely. But that assumption ignored a structural difference between Disney's old world and its new one. In the theatrical model, scarcity creates value. A movie releases in cinemas. It has a window. It becomes an event. In cable, bundling creates friction. Consumers pay for packages they rarely change. Revenue is sticky. Margins are strong. Streaming is different. Streaming is frictionless. One click and a subscriber cancels. That changes everything. In streaming, growth is easy. Retention is hard. Every new subscriber expects a constant flow of new content. Unlike software, where a single product update can serve millions at low incremental cost, content is expensive and perishable. Each show is a new investment. Each season demands fresh capital. Each franchise expansion risks fatigue. Disney was no longer monetizing scarcity. It was financing abundance. And abundance is expensive. Despite rapid subscriber growth, Disney Plus wasn't profitable. Losses mounted into the billions. The direct-to-consumer division burned cash year after year. Marketing costs ballooned. International expansion required discounted pricing strategies to penetrate new markets. The belief was that scale would eventually solve the problem. But streaming scale doesn't behave like tech scale. In streaming, incremental users increase content obligations. Scale increases expectations, and expectations increase cost. Meanwhile, a quieter problem was unfolding inside Disney's broader empire: cannibalization. By prioritizing Disney+, the company began undercutting its own high-margin businesses. Theatrical windows shrank. Some films went directly to streaming. Box office revenues became less predictable. Cable networks, once reliable cash machines, faced accelerating subscriber declines as cord-cutting intensified. Disney wasn't just competing with Netflix, it was competing with itself. Every strategic decision to strengthen streaming risked weakening legacy profit centers that had historically funded the company's growth. The empire was internally rebalancing, and not always in its own favor. Then came the macroeconomic shift. For years, Wall Street rewarded growth above all else. Low interest rates made capital cheap. Investors tolerated losses as long as user numbers climbed. But in 2022, that mood changed. Interest rates rose. Capital became expensive. Profitability returned as the primary metric. And suddenly, streaming losses that had once been dismissed as investment phase became unacceptable. Disney's stock price fell sharply from its highs. Activist investors increased pressure. And in a dramatic move, Bob Iger, the architect of Disney's acquisition-driven golden era, returned as CEO. When a legendary executive comes out of retirement, it signals more than routine transition. It signals structural concern. But the most important mistake wasn't overspending. It was misreading human behavior. Disney assumed that powerful intellectual property would naturally translate into long-term retention. The logic felt obvious. If audiences love Marvel and Star Wars, they'll maintain subscriptions to access that universe. But streaming consumption patterns revealed something uncomfortable. Nostalgia attracts subscribers. It doesn't necessarily keep them. Binge culture compresses engagement into short bursts. A new Marvel series might drive a surge of subscriptions during release, only for churn to spike once the finale airs. Streaming rewards novelty, not legacy alone. To maintain momentum, Disney had to release content continuously. That pressure increased production speed. Increased production speed risks quality dilution, and quality dilution erodes brand trust. Disney's brand was built on premium storytelling. Under industrial content pressure, that premium perception faced strain. And when brand perception softens, pricing power weakens. To offset churn, companies bundle. To offset bundling discounts, margins compress. This is the retention trap. Growth masks fragility until it doesn't. Financially, the consequences were real. Losses in the streaming division accumulated into the billions before gradually narrowing through cost controls and price adjustments. Subscriber growth plateaued in key mature markets like the United States. International markets brought volume, but often at lower average revenue per user. Raising prices risked churn. Keeping prices low restricted profitability. Meanwhile, competitors adapted. Netflix introduced ad-supported tiers and password-sharing crackdowns to increase revenue efficiency. Warner Bros. Discovery restructured aggressively, consolidating assets and cutting costs. Amazon subsidized Prime Video through its broader retail ecosystem, treating streaming as an engagement tool rather than a standalone profit engine. This wasn't a quick conquest, it became trench warfare, and Disney entered that war with a legacy cost structure built for a different era. The deeper strategic error becomes clearer when we zoom out. Disney treated streaming as a distribution evolution. In reality, it was an economic revolution. In theaters, scarcity drives anticipation. In streaming, abundance drives fatigue. In cable, bundling creates retention through inconvenience. In streaming, consumers curate their own bundles monthly. Switching costs approach zero. Disney optimized for subscriber numbers. But the real metric in streaming is lifetime value relative to acquisition and content cost. Retention efficiency matters more than raw growth. When growth obsession dominates strategy, structural fragility hides beneath expanding numbers. And when the capital markets shift, that fragility surfaces quickly. Zoom out even further. Disney's challenge reflects a broader shift in media economics. For years, technology culture promoted the idea that scale solves everything. Acquire users first, monetize later, dominate before optimizing. But entertainment is not code. You cannot iterate storytelling infinitely at declining marginal cost. You cannot compress cultural production into an algorithmic loop without consequences. Streaming democratized access. It also commoditized attention. Audiences are less loyal. Choice is infinite. Switching is effortless. The moat is thinner than it appears. Disney Plus is not collapsing. Losses have narrowed. Advertising tiers have expanded. Cost discipline has improved. Strategy is recalibrating towards sustainable margins. But the structural tension remains. Can a century-old storytelling empire thrive in an environment where algorithms influence visibility, churn determines stability, and quarterly earnings dictate strategic patience? Can a company built on event cinema fully adapt to an always-on subscription battlefield? Or was Disney Plus the first clear signal that the streaming wars were never truly about content supremacy? Perhaps they were about endurance, about capital efficiency, about surviving long enough in a low-margin, high-expectation ecosystem where growth alone is not enough. Because if Disney, armed with Marvel, Star Wars, Pixar, and unmatched brand recognition encountered this level of strain, what does that imply for companies with weaker libraries? What does it imply for the sustainability of the entire streaming model? And if this was only the first visible casualty of the streaming wars, who's next?